right, good morning, everyone. I hope everyone's doing well. My name is Mel, and I'm the current community manager over at Kilimani. New face here, so if you see me anywhere, say hi. I hope everyone had a wonderful Easter break, that everyone's rejuvenated, and of course, keeping safe, sanitizing, and keeping as much of a social distance as possible. So today we'll be having a workshop, and today we are hosting Kwara. So Kwara, they work here with us at Kilimani, and Cynthia Wandia, who's the current CEO and co-founder, will be taking us through basically how Fintech is supercharging traditional structures, right? So with COVID, everyone has had to either pivot or take advantage of the pandemic and take advantage of the current economic structure, I suppose. And she'll basically be taking us through how Kwara has switched things up, or what they've done to develop themselves during this pandemic. So Cynthia, I will yield the floor to you. And throughout this workshop, we will be posting a couple of polls. So if anyone has any questions as well, you're welcome to do so in the question tab on the right-hand side of the screen. You're welcome to participate in the polls as well. And yeah, just a big thank you from Nairobi Garage, and thank you as well, Cynthia. The floor is yours.
Of course. Thank you so much for having me. And thanks everyone for joining on this fine Tuesday. Very happy to have you here. So my name is Cynthia Wandia. As mentioned, I'm co-founder and CEO at Kwara. I've been a long-standing member of Nairobi Garage, which has been a pleasure over the last couple of years. And so when the opportunity came up to lead a workshop, it was with pleasure that we decided as a company to participate. The title is How Fintech is Supercharging Traditional Structure, which was relevant to our of course, our company's case, and I'll introduce the company in a bit. But this particular workshop will be a little bit different. I'm not going to bombard you with a presentation or anything like that. I will be inviting more of a crowdsourced brainstorming, because I think while Fintech is one great example of how traditional structures can actually be brought into the 21st century, it's not the only one, not by any means. Let's see, can anyone confirm the connection is okay? Because it looks fine from my side, but hopefully.
Yeah, your connection is fine.
Okay, excellent. Sounds good. So first I'll start off by just introducing myself. I'm Cynthia, and born in Kenya. I left for college about 14 years ago. And over the course of that period of time, I've had the chance to live and work in a number of different continents, primarily in the energy space, but then about 3 years ago, had the opportunity to look closely into what I found was an interesting problem, which was originally a supply chain problem that was affecting smallholder coffee farmers. And in the process of looking into that problem, we encountered the SACCO, the Savings and Credit Cooperative, probably well known to most people on the call. Also well known globally under different names like the credit union or community bank model, and so on. And so what Kwara does is we digitize the world's financial cooperatives, giving their members a modern way to run their to manage their money, to build up a credit score, to just basically become financially independent, while at the same time giving the cooperative a modern way to run their banking business. So they are in the business of taking deposits and lending back some of those deposits to their members. What we noticed is over time, there had been a big gap left between what you would consider modern or neo financial institutions and traditional ones like the SACCO. And we actually made the decision, rather than let's say disrupting them or trying to upend them or replace them, we made the decision to supercharge them and move them into the 21st century. because of some of the topics that we'll cover in today's workshop. So the structure of the workshop will be as follows. As I said, it's more of a crowdsourced brainstorming exercise. There are a couple of questions that I pulled together that will be used to spur some of the conversation. At any point, there will be a point that will be or two. However, at any point, do feel free to drop in your answers in. If there's a question, drop in some comments in the chat. I'll be able to sort of coordinate that. And do feel free to sort of to comment and contribute. Like I mentioned, even though we'll focus on fintech because that's where Kwara's is sector placed. I do think this question can be asked about a number of different sectors and industries. And so we'll, taking into account there might be a number of people on the workshop who are in different sectors, we'll make sure to sort of bring those different sectors and different perspectives in. Great. So again, thanks a lot for joining. Kwara was founded in 2018. Our goal is to enable the world's 3 billion financially served to become financially independent. We started off in Kenya, which has a very strong and robust credit union segment or SACCO segment. But from day one, we've been looking at how this particular institution operates globally. What role does it play at the last mile in providing financial services where the big banks or the commercial banks have not yet reached, and basically how to ensure that it continues to deliver the same value for the next 100 years as it has for the last 100 years. So I'll start off with the first question that we sort of picked out, and maybe I'll just set the scene, right? So fintech today is clearly a major catalyst that is driving innovation across the world. A number of solutions have been developed, and those have gone a long way to fast track the transformation of traditional structures. So in most cases, you've encountered in one way or another an improvement in either how you get your services or basically how your banking or financial needs are met, and that is typically due to the emergence of technology. So this has helped to radically improve efficiencies across many sectors of the economy, but it has also sparked the conversation on the need for fintechs to work together with traditional financial institutions. So maybe taking a step back, the topic of startups in general, no matter the sector, has always been held in the context of disruption, right? So the idea that the way things were before doesn't work, and there's a need for a sort of radical upending or almost a creative destruction of the way things were before in favor for a completely new way things are going. And that's been, you could say, the startup motto throughout since maybe the origins of whatever is now considered a startup. And this is something that we, of course, took into account also from day one. But the first question is sort of how can these two entities, how can fintechs and financial institutions sort of spur each other? So not necessarily one developing at the expense of the other, but rather how can they collaboratively compete? And for this particular question, I wanted to bring up two cases that I've noted over the course of my career, two different segments. One is in the case of Europe. Financial institutions and fintechs have quite an antagonistic relationship in Europe. There's very much a clear old versus new. I'll give some examples. There are some, long-standing commercial banks like Deutsche Bank or the just established for a long time, having had a long history of serving corporates as well as institutions, as well as retail. And it must be now maybe 5 or 6 years ago when there was a new entrant on the market. This bank, neobank, was called N26. So N26 came onto the market with just a debit card and an app. And what was particularly interesting is the narrative that N26 or the neobank took was very much an anti-bank narrative. So there were lots of advertisements everywhere about how, the banks have let everyone down, and, basically banking is so 1900s and so on. And I was surprised to see how directly these two institutions were sort of going against each other. There was some cases of banks warning people, hey, if you put your money in these neobanks and they go under, you're going to lose all your money. So it was a very clear old versus new, and us versus them. And then I contrasted that with the situation that we've seen. I would take Kenya as one example, but also in a couple of other emerging markets, where you find a much softer relationship or a blurred line between where the traditional financial institution stops and where the fintech starts. So starting off with, of course, there've always been informal financial structures, whether it's the chama or the sako or going up all the way until the banks. That's very contrasted with Europe, where the institutions have existed for a long enough time that they have sort of taken the role that used to be played by the informal sector. So in countries or markets like Kenya, you still have the presence of quite informal or softer financial service providers, let's say. And then when you notice how innovations came into the market, there was, there were a number of different entrants. You'd have the telcos coming in with some version of a product that was playing a role in the financial sector, like M-Pesa. Then you saw a couple of lending apps coming in. Then you saw fintechs trying to extend the infrastructure of banks towards the last mile. Then you saw banks starting that sort of instant lending, or even like pay as you go type of offerings for purchasing large value equipment. And so you see a bit more of a symbiotic almost rather than antagonistic relationship. And the take that I wanted to share today is that it 100% depends on the sector and the segment and the market in which you're operating. But taking the example of emerging markets where there has been a less linear development in digital services, whether in the fintech space or otherwise, we're more likely to see success in a partnership approach than in an us versus them approach. And this is something which I wanted to open with because it does set the scene for some of the following questions. But on this, I would love to hear some thoughts. If you agree, first of all, that in markets where there hasn't been a strong and long history of institutionalized services, especially in the fintech sector, that it does leave a better opportunity for collaboration between fintechs and financial institutions versus direct antagonism between them. So would love to hear your thoughts on that. Of course, sometimes the giant will win, right? So you could see instances of a large institution directly copying what a fintech has done, but having more resources and so on. Or on the flip side, you'll see that the agility offered by fintech is unmatched when it comes you look at the traditional financial institution. But on average, there is quite a tendency to see more value being created by a cooperation than necessarily a direct antagonistic approach. So that's sort of the opening comment. And then the second sort of question that ties very closely to that is, then must fintechs, in order to be considered innovative, must they actually replace traditional financial institutions? And here I'll ask the Nairobi Garage to send out the poll, because I'd love to hear, first of all, your take on this. Like, is the definition of a fintech, or does it exist to actually replace a traditional financial institution? So Nairobi Garage team, if you could send out the poll, that would be great.
All right, we're doing that shortly, Cynthia.
Okay, great. And as far as questions are concerned, do please send your questions in the chat. There is a questions function. I think I will address them. I can address some of them as we go, but otherwise, if we don't get to them in the course of the actual workshop, we would get to them at the end. Yeah, and I think I'll come to Elvin. I've seen your question. I'll come to it towards the end. So when we come back to what Kwara does and how some of these are handled. So first, I just want to pull the crowd, see what you think about this. Must fintechs replace traditional financial institutions? Or put another way, is it inherent in the DNA of a fintech to replace the traditional financial institutions that already exist? So we'll take about 30 seconds to vote. Let's see. Okay, super. Okay, so we've gotten a couple of the answers, overwhelmingly a no. Some people say yes, and I would love to hear some thoughts on that. So please send your comments, whether as a question or as a comment, so we make sure we get your point of view. Majority have said no, and here I would just pivot a little bit to speaking about Kwara, and maybe Elvin, this will also answer your question. So at Kwara, we started off also by looking at this question. Like we looked long and hard about at the traditional financial sector, all the different parts of it, and when we let's say found the SACO or understood it as a financial institution, we dug deep into its history and its ethos, and ultimately we decided that there was actually more value to be created by supercharging this existing financial institution than there would be by replacing it. Or to put it the other way, the cost of the destruction of value that would have occurred had we attempted to sort of go head on and replace that financial institution did not compensate the potential creation of value in whatever new iteration of a venture that this that it would have. And here I would sort of answer the question, like asked, what is Kwara's unique approach from the zillions of startups in the financial industries? And I think one of the first unique approaches is that we actually took to we decided not to reinvent the wheel in the first place. The institution of people coming together to pool capital under this social net of trust was so, and having built up that behavior around it, we decided instead of replacing it, we would supercharge it. And most people will tell you, or if they haven't, it's really known, the hardest thing sometimes to change is behavior, human behavior. And so when we saw that there's already a positive behavior there, so a savings culture that is very tightly built around social trust, the cost to disrupt it and try to convince people to have a new behavior at the expense of all the historical and financial assets that have been accumulated, that was not going to be viable. In terms of what specific gap Kwara fills based within that sector, most of the SACCOs operate in a gray zone. They're bigger than a chama, right? So a chama is completely fine for if it's your mom or your dad and their 10 friends meeting once a month, mostly on a social basis, but they take 2 hours to sort of record the payments and so on. Even a counter book is fine for that. And I've seen that work quite successfully. And they don't want to replace the social aspect of it. You can't give them a solution and tell them, now you don't have to meet anymore. They want to meet once a month. And they're meeting the needs of this particular group of people. Then on the other side, you've got banks, you've got large financial institutions that have systems that have, they also have the kind of income, like they generate the kind of income that allows them to invest pretty heavily in software solutions that keep them modern, keep their data safe, keep their money safe, and so on. But then you have SACCOs in a bit of a gray area. They're not as big as a bank, or they don't earn as much as banks do to be able to invest, tons of cash into their systems. At the same time, they have outgrown the sort of smaller trust-based institution that they might have started out as. And that's the gap where we fill. So we identified the potential to provide a SaaS-based banking platform that basically, with the decision to take Kwara, they can, from the day after or once they're onboarded, enjoy the full infrastructure that exists in the formal financial sector without having to pay the sort of upfront huge amounts that a bank or something like that can afford. And it all came from the decision not to necessarily replace fintech, so traditional structures. And I see a comment here from Kwara that the relationship between incumbent and challengers is slowly turning into a somewhat symbiotic one. Traditional institutions are starting to wake up to collaborating with or acquiring fintechs. I wonder what role regulation will play in this kind of relationship in the future. And that is an excellent question. We actually come to the question about regulation towards the end, because you're absolutely right. Both sides are sort of waking up to the fact that maybe it is unique within the global south. As I said, when I gave the example of N26, they were backed by a lot of firepower. So venture capital was willing to really put a lot of firepower in backing this, let's say, the challenger, right? The David versus the Goliath. But when we look at markets like Kenya, we look in the emerging market segment, to some extent, and this is really in my view, I don't think we can afford to destroy value in the name of innovation, at least not yet. And so that's why the symbiotic conversation comes up, maybe sooner than later. And even if you start off and you want to disrupt everything, sooner or later you find you can actually do more by partnering with some of the incumbents. And I do think, I also do agree that they are waking up to that. So the other question I would ask is then, what other industries would benefit from this approach, right? So fintech and financial infrastructure, financial institutions is sort of the go-to when people think about disruption and innovation and tech and sectors that are being ended, but it's not necessarily the only one. Maybe it comes to mind because finances and money are very personal and they affect every subsequent aspect of our lives. But there are other industries that could benefit from this approach. So let's think about aviation, right? Aviation is a sector which has extremely high upfront costs, right? If you're going to run an airline, if you're going to run an airport, the safety compliance, the amount of training and expertise needed does mean that over time, the incumbents have built up quite a significant moat around them. But that doesn't mean that they have, they are able to enjoy the benefits and the agility that a startup would, right? So that's another sector where it's sort of ripe for the, whatever it's called, maybe aviation, AvTech, or whatever, the acronym for this, can come in and actually symbiotically work with the incumbent to find out, how do you provide a better experience? How do you resolve issues faster? How are you able to actually react faster, but then eventually sort of predict what your market wants, all while still being able to leverage the very long-standing amount of expertise, capex and capital, so assets that you've built up. How would you be able to balance the two? Healthcare is another one, and not just sort of that, end value chain healthcare. When you think about upstream, so even in the manufacturing of like high cost medical devices and so on, it's now the preserve of the Siemens and the GEs of the world, because they've invested a ton in sector. But they could also benefit from the agility we've seen from startups, which have been able to come up with products very fast, especially, for example, reacting to the pandemic. We had in-home testing. We had, I think in Senegal, people quickly trying to come up with a rapid test. So there are other sectors where the agility of a startup can work very closely with the historical know-how, expertise, and even like legalities that have been set up prior to that by the incumbent. And for this, I would sort of share one observation I've made, which I would say is also somehow a bit of a tip. Sometimes the key to unlocking success in one sector actually lies in another sector. So you might be, and I would encourage sort of a curiosity about sectors outside of where you work, because the key unstick a customer need or a problem in one sector might actually be held in another sector. So we saw a lot of like Uber for X or Uber for Y after the fact, and maybe that's just a more trivial example of the same, but just as an outcome, like, do be curious about how other sectors have sort of solved challenges and unstuck them. Because sometimes innovation is not just doing something completely new, it's just doing that over there, right? So doing this that has been done here successfully, doing it somewhere else. Just coming into a next question, like, what does it take for a successful partnership between fintechs and traditional institutions? Here, I would love to hear, especially if anyone has had any experiences of this. I can share the experiences that we've had, because as soon as we decided the SACO sector was a partner, we're going to work alongside it, and we're going to help be the link between the SACO sector and what we would call, let's say, the formalized or even, let's say the formal financial sector. We immediately wisened up to the fact that we're going to have to work with some longstanding institutions. They could be longstanding credit reference bureaus. Yes, we can build our own credit referencing algorithm, but again, if there has been systematic work done to collect meaningful financial data across the country by an institution, it's the same thing about, like, to create, you don't necessarily have to destroy, right? And so we took the first decision we made was we're going to connect or make it easier for SACOs to access better decisioning data. And we're not going to claim that we have better decisioning data, because we're not going to take people's data from their phones without consent. There's an institution that's already been licensed. They've gone through acts of parliament to be established. They have certain ways that they're required to operate. And they, over time, have collected a vast trove of financial data. So why don't we connect that institution, which is in this case the credit referencing bureau mechanism that in Kenya is represented by 3 companies? Why not connect that to the SACO sector and just make it, sort of seamless, right? One-click referencing as you're checking a loan. And that's just one of many of those decisions that we took, where we were like, okay, who's already done it really well? How do we link it? How do we just make sure information is flowing safely? People are able to make better decisions without destroying value on both sides. And what I can say from our experience with that is, in terms of what does it take for a successful partnership, first is expectations management. And I think that needs to happen on both sides. It's easy to say it from the startup side, right? So you have to, I think a startup can only underestimate the bureaucracy that exists within a traditional financial institution. And I would even say underestimate it at your success, right? Like to your advantage, because it will help you plan and prepare accordingly. It does sometimes seem counter-intuitive, because in your startup, you have a flat hierarchy, decisions are made instantly, and so on. And you forget that part of the process of becoming institutionalized is that the institution must be able to survive even the absence of a certain key person, or the decline of an entire department. Like, the institution must survive beyond the people who are in there. So all the processes, all the structures that are in place. That is the process of institutionalization. And at some point, you're sort of tend towards. So there's that first aspect of expectation management. Be prepared. It's not necessarily going to be like an MVP feature that you would quickly ship on your product. Be prepared for all these different processes. There's going to be, or there might be quite a bit of compliance requirements, and all of these are done to. Their job is to ensure the integrity of the financial sector as much as they can. They have a legal requirement too, and ultimately they have to comply with it. On the other side, expectations management is really important from the traditional financial institutions, which sometimes might also expect that the startups have far more resources available to them, or let's say equivalent resources, right? And so some of the things there are, so some of the ways that they interact with startups, it comes from a perspective of, well, you must have, about 15 people in your risk department who can actually handle this like long KYC process that we have. But you don't. You have maybe the founders who are going to sit down and handle it, and they're going to do their best, to put their best face forward so that they don't lose the deal, but at the same time putting quite the startup under quite some pressure. So that's been my biggest takeaway is expectations management on that front. Everything else can then be moderated based on that. I see a comment, a really helpful comment here from Kwara, answering it from my own experience. What does it take? Number one, empathy. Not all traditional institutions will be able to adopt agile, and not all nimble fintechs will be able to work around rigorous governance models. And number two, a strong relationship with the regulator, and a regulator who's willing to learn and adapt. I think empathy is a really great way to actually encompass the process of, hey, we both agree that we can, in the end, do something good together. We do agree, and we're going to just try to figure out what works best for you and what works best for us as a fintech to get to that common goal. And it's probably important to keep reiterating that common goal, because at some point, again, in the different layers of levels that you interact with, that can then get missed. Yeah, so your case gets put to a third or fourth department, and they might not have that initial question that you had with the original sponsor of the idea in the financial institution. So you have to sort of keep re-pitching and bringing people on board. But I do think empathy is a good way to put it, because it's just a reminder of everyone's strengths and limitations, and like recommitting every so often to that shared goal. And in that sense, I do think it's possible. There are some successful examples of it, but in the end, it does take quite an active role. Not discourage it by any means. In fact, I would encourage. It's not very trivial. Great. So I'll just move on to the next question I have on here for discussion, and I'll leave plenty of time to answer the questions shared. Yeah. So this one's a bit. Is disruption the only way to drive innovation? And it comes back to that original topic of startups. Is that what they exist to do? And here I'll ask the Nairobi Garage team to just share the second poll that's related to the same.
All right, we are publishing the poll, and yep, it's live.
Thank you. Yeah, so what do you think? Could as it did, disrupting industry? Very interesting, very interesting. So we have an almost overwhelming, so 88% on no, a few I'm not sure, and a few yes. And I think the semantics in here is important, because then we have to define what does successful mean, like what does succeed mean. Personal, and now please share your thoughts on this, because I've also the view that with two ways of and you could say there could have been the Uber as we know it, and there could have been an app for taxis, let's say, like the existing taxis that were there. And perhaps when we think about the, what were the factors that helped Uber succeed? My take on that is the primary thing that helped Uber succeed was that they delivered an incredible user experience. So they bet on the fact that if you used it once, there was no way you were going to go back to how things were before. And they basically put their money on that. And it worked because they broke down every single what take a ride home from wherever you are, and every point at which you would have some level of friction, discomfort, or awkwardness, and they just sort of took it away. But could that have been done, or could that not have been done with the taxi industry? I think the answer is yes. It could have been done with the taxi industry as well. But what they were willing to put, of a war chest behind the effort to make sure as many people experience that, user experience as before anyone could ask any questions, before the regulator could ask questions, before just make sure everybody has tasted it, that basically have a group of when the regulator comes or when the competition comes for you, or the incumbents, you have already mobilized your, let's say, your army of supporters who I look at the alternative, or look at the cost to the existing sector, also the cost of the existing participants, let's say, in the Uber ecosystem. We can't help but think whether there could have been still value created alongside, like, without having to destroy quite a ton of that. Sorry, guys. I think my bandwidth sort of froze up there. Should be back. But I would love to hear thoughts on this. So we took the view that there could be a neo, we could launch, a neobank. It's not trivial by any means. I don't say it like it was a trivial decision. It's not easy by any means, but that could have come at the expense of quite a significant part of the financial ecosystem. And we did not think that the risk of that value destruction would have justified the additional value created. And I think every sector might be different. Maybe there's a reason, perhaps there's a reason why Uber, so that model particularly worked for that sector. But I would say that this is a question for whatever sector you're in. You may, are you going to, take the incumbent head on? Are you going to take the incumbent head on, or are you going to work adjacent to the incumbent and sort of supercharge them? They've already put a lot of things in place. It's likely a more capital efficient approach. You're not changing behavior per se, but you are supercharging existing positive behavior if it exists. And in that sense, there's the additional value created, while maybe not as much much as you would see in this completely disruptive sense, also doesn't come at the expense of destroying existing value in the alternate sectors. And like I said, it's there's a lot we can learn from the Uber case and how they grew, and every sector is different. But what I want to posit is that there is an alternative. It should not always be the default that that you have to burn down the incumbents, let's say, in order to succeed. There might be an alternative way, an adjacent way to work alongside them in order to actually create value, and again, not at the extent of value previously created. So the last two questions that I had as discussion points before I go to the crowd's questions: how can fintech companies or institutions? I just, there's a couple that come to mind immediately. It's just first in a technical sense, like opening up each other's USPs to each other, right? So if a fintech has a USP of that last mile access, they're agile, they can go where the bank can't go, then the bank should open up its sort of integrations, make it really easy to access, to connect, and to just like keep value flowing. Last mile access is a huge topic because as you institutionalize, you also just it becomes harder for you to move beyond or outside the realms of existing infrastructure. In terms of a user experience, again, fintechs tend to be very close with their customers because they are either trying to acquire them, in a relatively competitive space, or they adopted the belief that give two experiences, the user will picking that delivers a bit of a magical moment for them. So that's something that because in a sense that's usually all they have when you're starting out. All you have is the ability to delight the user, have the historical, a huge capital base. You don't have this longevity, but you can give an aha moment to an end customer. And that's somewhere where I feel there's an opportunity for fintechs to collaborate with traditional financial institutions, almost like to make sure that there's that clear translation of user needs and real customer problems, and that pulse on what's actually happening in the customer's life. It does sometimes feel like the traditional financial institutions get more and more removed away from that sort of magic moment, and that's another place where it's they could work together. And the last one, in the sense, is launching new products. And I think we've seen a couple of really good examples. Tech has actually been able to very sort of on behalf of, or maybe the regional, and that combines the best of both: an agility to iterate and ship relatively fast, combined with the sort of foundation that's required to generate and support and sustain these kind of new products. So that's another area where I feel between the two, let's say, entities, there is a possibility for like quite some strong symbiosis on that. So with regards to the regulator, right? Like, can the regulator accelerate change in the financial sector by working with startups? I would say, generally yes. I think I would bring up the point, what happens when that symbiosis between the financial institutions and fintechs accelerates? What is then the role of the regulator there? Is it to protect the startup, from potentially sort of being accidentally swallowed up? Is it to protect the traditional financial institution by making sure all the, prudential guidelines are followed and so on? Where does it play? I think in Kenya, we've gotten to see quite an an agile regulator on both sides. So working very closely, of course, with the financial institutions, but also being very much in the room where startups are conversing and giving them the audience to sort of exist, but not just exist, but thrive. So as we move forward, I think I continue to look forward to that symbiosis sort of both overseen by, but also very much like catalyzed by the regulator. If it means putting, both sides in the room and sort of, laying some groundwork for collaboration, that would be appreciated. But in general, I do see first that there is a possibility for the regulator to accelerate change, and second, I do also see a need for the regulator to keep an eye on this developing symbiosis between both, because I think both do need a level of protection and support in order to succeed, basically. So for the last couple of minutes, I'll take some of the questions here as much as I can, and I think yes. So Willis asks, how do we create an ecosystem where everyone, government, academic institutions, industry participates, and where corporates are not stealing ideas, but supporting these new innovations? Tough question, because there's two parts. There's, on the one side, we always, I've heard before, and it's something I've come to subscribe to, that an idea is one thing, it's the execution is something else. And so in that sense, and they're almost like, there's every idea that's been had, like someone has had it before, it's just about who has executed it. But I do see the concern, because you will, there are incidences of like, you pitch and then maybe your idea gets implemented and maybe not very well, and then it doesn't succeed. And so it's nobody wins. I do think there's a little bit of sensitization that should happen in corporate innovation departments, that should not see like the ideas coming up from startups as like, oh, that's just something that we should copy. Let them execute. Let the startup execute on that problem. Let them iterate, because they are far more agile. So much. Let them iterate on it, and they'll do it in a way that is likely to be much more, I'll say, desperate, right? Because a startup needs to survive, right? A corporate can have a number of initiatives, and if some work, some don't, it not material. But for a startup, typically, that's the one thing that they need to crack, and they will put everything towards it. So again, in the spirit of not destroying value versus, creating additional value, I think the main message there is for any sort of corporate innovations departments, yes, you're required to come up with new ideas, maybe it's part of your goals and so on. And so you come across what a startup is doing, approach them, provide support. Probably it would cost you less to provide them with a bit of maybe financial, or even like that sort of backing, the credibility to launch that idea. Let them iterate. They can fail fast. They can, startups are designed, they're temporary organizations looking for a repeatable, successful business model. So they can iterate much faster and find the sweet spot of how that particular idea should be executed, and then come in with, a decent offer. Are you going to distribution channel? Are you going to acquire them? Or are you going to, and then at some point, maybe it's even a fair fight there, then if you want to actually come in and compete. But I do think we actually destroy more value by acquiring or directly copying startup ideas, executing them badly, then it gets shut down. Then everybody, sort of thinks that the problem wasn't worth solving, when in the end it was just, sort of, it was just destroyed from the beginning. How did you establish the pricing packages? I think this is with regards to Kwara. A lot of research, and it's a continuous iteration. So there's a couple of tools we've used, like the price sensitivity meter. We do pricing surveys. we try to understand how does the client perceive the solution versus the value they get. There's a great quote I once heard that price is what people speak about in the absence of value. So for as much as possible, try to understand the value that the product you have provides, and you can do that by directly asking questions. You can do that by having them sort of rank how much they would allocate to each feature and so on. And then when you come to a pricing, keep your mind open, because over time, pricing is one of the most important levers for profitability for a startup. So be open to revising it on a regular basis. What do you personally see SACCOs in the next 20 years, and what do you anticipate Kwara will be doing then? To be honest, I do think SACCOs are, in a way, the way that banking was supposed to work in the first place. So there's something about that self-sustaining model, that incentive alignment that comes from when the depositors and the shareholders are the same, that just feeds into its. All while having really established themselves as the best way for a individual and a community to become financially independent. And that just means the ability for them to build wealth, get out of debt, access their, develop. Oops. Oh, yep, I'm back. Sorry about that. Yeah, and I do see them as the best financial institution, let's say, to actually help people get out of the situation they're in and towards where they want to go. And what do you anticipate Kwara will be doing then? Still powering them to the max. And currently we power them with technology. Eventually we will power them with insights, and beyond that, we will always be looking to stay one step ahead of their needs and their ambitions, and basically innovating on how we could meet those needs when they arise. So Diana Mungar asks, how has the financial regulators in Kenya supported the fintech ecosystem so far, and how could they do even more for that perfect symbiosis between traditional and modern financial institutions? So I was saying, in Kenya, I have experienced, and this is personal experience, I've experienced a very open regulator, one who gives both the audience to, of course, the traditional institutions, but also gives a direct audience. I think that's quite material. So in allowing for and supporting and really sort of lifting up startups, there's a clear message there that innovation and value can be created even by a group of young people coming together who are just funded by like the next M-Pesa, the next innovation. So far I've felt that it's been pretty open, and in terms of how could they do even more, I think kind of linking it back to an earlier point about keeping an eye on this increasing symbiosis, making sure that everybody is protected and safe, so that it actually becomes mutually beneficial both sides. I think there's the law and there's regulation and there's compliance is mandatory. At the same time, it's about listening. Okay, as we discover new problems, how do we ensure that the regulation is keeping up? How do we deal with when we come into, right? Because the nature of innovation means you actually come up into a situation that didn't exist before. So is that empathy there? Is that ability to sort of like collectively find a solution? And I would like to see regulator continue to do that, continue to make sure that in a better Kenya, a better Africa, everybody wants a better situation. So we're on the same page for that. So make sure we kind of address all the hurdles that come across, that we come across on the way. Cecilia Depot asks, do you have any insights why SACCOs in Kenya have become ticking bombs? Every other day there are scandals involving SACCOs. Can you touch on that? Yeah, absolutely. there's a big topic on governance, which is one of the biggest challenges that a SACCO has. Members entrust their leaders to act in their interests. It's the same way citizens trust their governments to do that. And that doesn't always work, but there is always this ability for the members to sort of step in and say this is not working as it is. I do think there has been a disconnect in how, or over time, and part of it is really because of the lack of technology. There has been a disconnect in the speed at which issues can be resolved or issues are uncovered. If you find a governance issue a year later, maybe under a new leadership, right? The new leadership might just be incentivized to sweep it under the rug and try to move forward and so on. And there's an affirmation and of compliance with that member apathy, which over time meant that, you know, you're a member of a SACCO, you deposit, you borrow, but you know, you're not attending the general meetings. And why? Because maybe it's not very convenient, and you can't make it each time, and so you're a little bit removed, right? It's like there's citizens who don't vote, and then they wonder what's going on in the government. So there's an aspect as well of member involvement. It's a very powerful institution, and that power is concentrated in each of the members' hands, right? So from any, you know, and the other thing I've noticed is like bad news spreads widely. So as you said, every other day there are scandals involving SACCOs. Every other day there's 10 or 15 more great stories about SACCOs, people whose lives have been changed, people who've managed to completely change the situation. And those stories are also not told, right? So in proportion, and part of why SACCOs remain extremely relevant is there's a lot more good that happens than ever hits the airwaves. And that's also something that at Kwara we really wanted to commit to, is we just want to tell the story of this institution. Most of us know it because it has educated our parents and our grandparents. It has brought us quite far and provided a level of financial security that is unmatched. And we want to continue telling the positive stories while providing the tools to minimize the negative impact that a bad actor can play. I do notice it is time, so I want to just sort of time and respect. Thank you very much for the opportunity and for joining. Thank you as well for putting up with my not very good internet today, but very enjoyable. My contacts, if in case anyone would like to be in touch for any reason, I have just shared. And otherwise, wishing you all a very successful rest of your Tuesday and week, and all the best.
All right, lovely. Thank you so much for that, Cynthia. I think it was really, really insightful. I think everyone had something to take home with them. Especially loved the point you said about how generally the news we hear about SACCOs in general tends to be very negative. I think people need to realize that when it comes to finances and all that, it's a very personal decision. Your risk tolerance is obviously very personal, and therefore one person's bad experience doesn't necessarily have to be everyone else's, right? I think I really enjoyed that chat, and we at Nairobi Garage are extremely excited about the fact that we get to be part of your journey, we get to be part of the Kwara story, and we really do extend a warm welcome to everyone else as well. If you know of anyone who would be interested in joining the family, a co-working space, we really do cater for, I would say that Kwara is Exhibit A, in the sense that a lean startup, if you're looking just for a place where you can co-work and network as well as share ideas with other people, it's definitely the place to be. So we have Easter offers going. I know Easter is over, but we're still going with the offers. So from as low as 850 shillings a day, you can come on board and experience the product, get a feel of it, and generally just see if it's a good fit for your business and for your startup, or even just for anyone who's working from home. We are encouraging people to social distance. So there's plenty of space on all 3 floors here in Kilimani, but we also have locations in Spring Valley or Karen if you're interested. All right, so you can network and contact and follow Cynthia. You can also follow them on Twitter at @GetKwara, so GET Kwara. They've also got LinkedIn going, so that's just Kwara on LinkedIn, and you can definitely follow and contribute to the conversation over there as well. And from us, we just want to say a massive thank you for your time, and we hope that everyone's staying safe, and we'll see you on our next workshop. Thanks, guys.
Thanks, everyone. Bye-bye.
All right. Bye.